Yeah.
I'm sharing my screen, so I don't really see like what's happening on the chat. And
How do you change your background? Is it the option on Zoom?
Yep.
yes, yes. So when you click on video, there's a little arrow there, and you click on that, and then it says like choose background, and you can pick whatever you want. You can even have something like a video in the background, which is pretty cool.
Oh, there it is, virtual background. Let me see if I can have none. No, I don't think it's working with me.
Oh, really? I think that sometimes you need to I guess like close and reopen your Zoom. Um,
Yeah, let me try.
it's a cool feature because you can like put anything you want as your background.
Very strange. I'm just not able to do that. Very funny. But let's see
I see there's
if I
something.
can try that.
Okay, so I think we can start. Welcome everyone to today's panel, Fundraising for Startups Post-COVID. We have a really exciting panel for you tonight. Let me start by introducing myself very briefly. My name is Gabriela Melnik. I'm a co-founder and CEO of Liveroom. We're a professional networking and live streaming platform for people who are in the music industry. We're really excited because we're launching our beta in September, and also in September, we are joining Columbia Startup Lab. And fun fact is that this startup has come to be entirely remotely. If you asked me when was the last time I saw my co-founders, I really wouldn't be able to tell you. I'm really honored to be moderating today's panel. We have a fantastic lineup for you today. So I would like to ask every panelist that we have today to introduce herself. And let's start with Karen. If you could say a few words about yourself and your company, and ideally your experience with fundraising, just briefly.
Absolutely. I'm Karen Rios, co-founder and CEO of Lifesaver. And Lifesaver is a fintech company, and we're on a mission to turn those brick and mortar community banks across the country into cutting edge digital players. Previous to founding, I came out of traditional finance, working at a hedge fund here in New York City. And to date, I've raised a pre-seed round, family and friends, as well as some money from some accelerators and incubators. And we currently are raising our seed round.
Amazing. Welcome. Let's move to Rebecca.
Hey, I'm Rebecca Bastian. I am the CEO and co-founder of OwnTrail, which is a platform that is reimagining mentorship to reach all women. I recently left my 15-year career at Zillow, where I was vice president of product and vice president of community and culture, to launch this platform. And it's been really an exciting journey so far. You can actually see I'm not away from my colleagues because there's 3 of us that have created a pod together. So we're all in my garage together right now. And we recently closed a $250,000 friends and family round. We're actually currently in the middle of a crowdfunding campaign that we're using to build awareness and test out some price points for our business model. And then I'll be doing a seed round later this year.
It's super exciting. Welcome. Let's move to Anu.
Hi guys, so my name is Anu. I've been a serial entrepreneur, have had 3 startups to date, managed to sell all of them successfully, exited all the businesses. Prior to which I've worked in private equity, strategy consulting, mergers and acquisitions. Outside work, I do a lot of volunteering work for refugees, worked on women empowerment programs with United Nations. In my spare time, I write for a few publications, including CNBC, Business World, Business Insider, typically about women empowerment, fundraising, entrepreneurship, tech investments, so on and so forth.
Welcome. It's super exciting to have you on this panel. Katie.
Hello, everybody. My name is Katie. I'm the founder and CEO of Viv, and Viv is an earth-friendly period care brand that delivers our products right to our customers' doors. So we're trying to really reduce plastic waste, create more access to menstrual care products. So far, we've done 3 accelerators. We're currently in Mass Challenge Boston, and we're gearing up for our pre-seed round, but have been bootstrapped to date.
Welcome. I'm super excited to be moderating this panel. We have a very diverse panel because everyone is at a very different stage. So just to go over the agenda for today, we're going to cover VCs, angel investors, accelerators, pitching, and financial projections. We're going to also have a Q&A session towards the end, and the Q&A session is going to last around 15 minutes. In the meantime, feel free to leave your LinkedIn handle in the chat if you want to connect with each other. We're always happy to connect. So let's start with the first question. What is venture capital and how does it work?
I can take a lead on it. So venture capital funds are basically more like private equity funds that are investing in organizations or startups or companies which are typically early stage to mid stage in growth. So that's what typically it looks like. VC funds typically invest in organizations which are looking at seed A up till about seed A to CD typically. How does it work? So like any other fund, venture capital funds tend to have their limited partners, meaning they raise money or capital or funds from institutional investors, from high net worth individuals, or from other funds. Generally, venture capital funds can also be a side pocket of a larger private equity fund who want to do small ticket size of investment in the early stage companies. So that's in terms of how they raise funds. How they deploy funds is they will probably be approached by founders or they'll be approached by early stage entrepreneurs who are looking for investment round. The way venture capital fund will look at, they'll do their due diligence in terms of whether they want to invest in this particular startup or entity or not at a certain equity exchange. So that's one part of it. Another very important part to keep in mind with venture capital fund is from the funds that they have raised from their limited partners, they generally tend to invest a lot in the first few years. So let's say a fund size is typically 5 to 10 years. So in the first few years, they would deploy a wide majority of the capital, but they will reserve equal amount of capital, which they can eventually invest in the same organizations to support them in case there is an additional capital need. So that's how largely they function.
Thank you. This is a really wonderful description. It's very clear. So let's jump right into the next question. How have VCs changed their strategy as a result of the current pandemic?
I'm happy to take that as it relates to sort of earlier stage companies. So I'd say a few things in the landscape have changed. I think Anu did a good job of sort of touching on the limited partner and GP structure that is usually the case in these funds. And, economic downturns largely affect everybody in the market, and VC is also one of these spaces. Their abilities to raise funds from more LPs are also affected. And I think that creates, because, the difference between venture capital and other forms of investment is relationship to risk and return. They are traditionally much higher risk. So I think under downturns, venture capitalists are pressed to sort of tighten up their investment theses and look at things that under better economic circumstances would have largely been massageable, to put it in a strange way. I think concerns around revenues are a lot more top of mind than they were, say, 8 months ago, particularly in the early stage.
Yeah, I think I can add a few aspects to it. I mean, how have that strategy changed? So to understand what has changed now, it'd be important to understand what they did previously or how they were evaluating. I think the classic example would be Uber and Lyft of the world, which kept on raising funds. And if you look at their business model or their financials right now, you understand in the past, VCs were very, very bullish on growth and traction. So as long as you're growing, as long as there's a huge traction on the platform, it was relatively easy to raise funds. And it was irrespective of whether you were really profitable or not. And even before pandemic, there was a lot of reevaluation around the way the VCs were investing, especially given the debacle of Uber and Lyft IPOs, WeWork, pre-IPO situation. So there was already like a lot of reevaluation in terms of how they want to assess the organizations and their health before they would invest in it. But I think pandemic just kind of created a sense of urgency. So a lot of venture capital funds now are moving away from the idea of investing just in traction. So what they want to know now is, are your unit metrics in place? Do you have a solid business model? Are you guys cash flow positive? And how are you going to optimize your burn and your capital influx to ensure the healthy state of the organizations or of the startups? So a lot of movement has been from just like feel good traction oriented investment to investing in actual businesses with solid business model and most likely with positive cash flow.
Mm. So in this way, let's move forward to the next question, which is which industries will matter more? Because you've mentioned that investors are more careful right now. So I would assume that not every idea will be as sellable as it may have been in the past.
Yes, I mean, in the sense like we can see in COVID, some of the industries have definitely been hard hit, right? Like gig economy, shared economy. They've definitely been very, very badly hit. So those industries will obviously see some kind of pulling back from their industry. Um, so in light of these events and with the new wave of challenges, I believe remote working, healthcare, anything which is more in the space of kind of being COVID proof, they will obviously take off. And the few that I can think on top of my head would be, like I said, the remote working or medical or in the med tech space. These are two things I think would be just very, very, very much of interest to the investors at this point in time.
Mm-hmm. This is very helpful. So with that, unless anyone wants to add anything regarding VCs, we can move to the next aspect of our panel today, which is angel investors. So to start with, who are they? Anyone? I think Rebecca's speaking.
Sorry, I was on mute.
Okay.
Happens every time, right? I can take that one from the experience I've had so far, where I think angels are accredited investors who are interested in investing in oftentimes early stage startups and supporting the kind of entrepreneurial community with their own funds. So the big difference between VCs being that VCs are raising a fund from LPs and angels tend to use their own funds to invest in. Sometimes they'll pool with other investors to create a syndicate, but I think oftentimes, might use some of the same rubric for evaluating investments that VCs do. And I mean, there's so much variety in who angels are. I think that's one of the harder things to figure out, is that there's this huge long tail. There's already quite a few VCs out there, but in terms of potential angels, it's like knowing where to start. I think in any community, any entrepreneurial system, there's going to be some of the more known angel investors that everyone kind of is aware of and talks to, and there will be some angel investment groups that you can get in front of a large group of angels through. But then there's going to be this huge long tail, which is essentially anyone who is accredited and is interested in making investments. So reaching them is kind of a different strategy in itself.
Mm-hmm. So how have they changed their investment approach as a result of COVID?
Yeah, I can jump in here. I think this is especially interesting, especially given that angels are entering at a really early stage, so they should be willing to be assisting you on those problems that you're facing firsthand when starting your company. And I think for anyone that's looking at angel investments, you want an angel investor that genuinely cares about your company and the problem you're trying to solve and is willing to brainstorm with you. And so as you may be facing your own issues starting your company, I would even turn to your angel investors or think of someone you would want to turn to during these times. Angels in general tend to understand that when they're investing, there's a pretty strong chance that X amount or great percent of their investments aren't really going to give them returns, but maybe one of those will. And so while I would say those are the ones who tend to back off a bit more, they're always forward thinking because they're entering so early. So they might not be thinking about what happens the next 6 months to year in your business. They're thinking 4 or 5 years out at least.
Mm-hmm.
I will add something here. I think Katie made a great point. But to add on something to that, they're obviously cautious. But I think what I've observed in the pandemic is that a lot of angel investors have become super active. It is because they think this is an opportunity for them to invest in an asset at a lower valuation, especially given the fact that in last whatever few years the valuation hit through the roof. And there were very many, not there were a lot of entities on ground, but they all came at a premium because everyone wanted to deploy capital and get a share of that. Now, angel investors see it as an opportunity, especially investors who have good risk appetite. They are out and about, actively deal sourcing, and they're very aggressively closing on a lot of deals. So I think there are two sets to it. There's a set of angel investors who have become cautious, but then there are others with high risk appetite who are being very opportunistic and very aggressive in closing the round at present.
Oh, so this sounds like pretty good news then. And that brings me to another question, which is where to look for them.
There's, I think Rebecca touched on this, there's definitely angel funds that are women specific. Golden Seeds comes to mind. 37 Angels is another one that's local here in New York City. But I think generally, they're everywhere. Alumni groups have them, Princeton, Columbia, etc. A good place, I think, to look for those first angels, which I think to echo what Katie was saying, are people who are thinking way longer term of your business and are willing to take on that early risk, is within your network. And what's great, about angel investors specifically is you can close them individually on these funding documents that are rolling. So it gives you access to capital a little bit faster than having to close a whole formal priced round.
Mm-hmm.
I would add as well, and this is less of a constructive statement, but more of just a statement, which is that this is where a lot of the inequity in fundraising comes from, is that so much of it relies on our networks. And so, someone who has a more affluent network, who does more investing, is going to have a leg up there. And of course, it's then a self-fulfilling prophecy in terms of, who has the success to make it to that next round or to build out their businesses based on who's getting that funding. So I think it's an important lens to apply to this whole conversation, because there is so much inequity in both VC and angel funding, and that's a big reason for it.
Yeah, I want to call out a few tools or resources that I've used or been a part of. And so one nonprofit that exists is called the Capital Network, and their whole mission is to help founders reach the point where they're able to start investing, and they'll help you with your financial projections and your pitch deck and put you in front of angel investors. And so there are nonprofits and tools out there that exist that are there to help founders and make everything a lot more equitable. So definitely check that out.
Thank you so much for sharing. This is very helpful. And also what Rebecca said about angels being more out there and willing to take risks. I've also noticed that people, because of the pandemic, or they are way more open to connecting and hopping on a call, which seems like a good opportunity to actually reach out to investors that otherwise could potentially ignore your call. So with that in mind, let's compare the two, VCs and angels. And there are two major questions that we have here. What does it mean to give up equity in your company? And then what kind of challenges you may have experienced while dealing either with VCs or angels? So let's start with the first question, whoever would like to tackle that.
Happy to take a crack at what giving up equity means and differentiation between angels and VCs. As Katie and Rebecca mentioned earlier, these are investors that come on very early on in your startup journey and in your company's journey. So you tend to actually, when you close an angel investor, not even, it's the promise of, if you're using something like a SAFE, which is a simple agreement for future equity, it's the promise of some equity stake at some point in time with caps on valuation and discounts, if you've given any, caked into this future agreement. So I think the first differentiators is that when you give up something to an angel, it's the promise of something that will be determined by someone else in a different, in an upcoming funding round. But all of this is essentially just an exchange rate, right? For either capital or sometimes talent, which many founders give up equity to early members of the team. It is a means to give up a portion of your company strategically for either capital or talent or a combination.
Mm-hmm. Great. Yeah, I think that explains it very well. So let's move to challenges. I think when we hopped on that call, Rebecca, you mentioned something about like challenges with investors. If you could explain a bit more.
Yeah, I got some opinions on this one. I happen to have the incredible timing of starting to fundraise just as the pandemic was hitting, so that didn't help certainly. And I think we talked earlier about what behavior has changed during that, but certainly the first couple months, people were definitely backing off quite a bit. And, I think ultimately we did end up with people who really believed in us, but I've had a lot of conversations. And what I've observed is that I'm hearing, so we at Own Trail, we launched in February. So we have a product out there, and we have really promising early traction in terms of women sharing their trails and really positive feedback about the experience. It's not necessarily venture scale numbers yet, but it's, we're seeing all the really positive metrics. We're pre-revenue. We haven't started monetizing yet. We do have an idea for our business model, and we still need to, and I think part of it is I'm very honest about the fact that, we're going to iterate on the business model, and we, it probably, I actually grew a lot of the business models at Zillow, so I know what it looks like to start in one place and then iterate from there, and I've been really transparent about that. And so then, what we hear from a lot of people is, really love what you're doing. You have a great team, a great vision. You're a little early for us. We want to see some more traction in terms of your business model. And that in itself would be okay feedback if I saw it being applied consistently across the board. And this is where the network thing comes in. And I'm actually fairly well connected, but I see, just to be completely honest here, I see a lot of very connected, wealthy white men getting checks written to them by each other because they have ideas in their head. So I'm talking no team, no product, no business plan, and there are big checks being written, and literally from some of the same investors I'm talking to that are telling me that I'm too early. And so that's where the disconnect really comes in, and where it does seem like there's some inequity being applied there and some different standards being applied. And so, I think I'm already in a lot of ways grateful for all the people that didn't write checks, because we have really incredible angels in our corner who believe in us, and we're not overly diluted, and we're going to make this work because we have the grit and we have the vision for it. But I do see some real disconnect in terms of how different founders are treated and answered in this space.
I would like to add on to what Rebecca has said. I've been founder thrice already, and I can tell you this is a serious issue, not just when you're starting off. And I like to share my experience when I was starting off. I cannot emphasize enough on what is the importance of network look like. I was very fortunate. I was at Harvard, and my classmate decided to invest in my startup. But after that, when I was raising subsequent round, so before I went on to raise subsequent round, I already had enough traction on my platform. I already had a lot of media coverage, and there was like a lot of interest in my startup. However, when I actually went fundraising, I had investors, white men, telling me on my face that you are a woman in tech and you don't have a male counterpart or a male founder. We don't feel comfortable investing in you. So those challenges are definitely real. But like Rebecca said, I'm grateful for all of that feedback and everyone who turned me down, because it just made me more determined, more aggressive in my search. I managed to sell my startup, but just before that, I think my biggest supporter was actually a GP who was a woman with one of the very known VC funds back in Southeast Asia. So I think one way to circumvent is to probably look for female investors, to look for female VCs, because I think they generally connect better, they empathize with your challenges. I think they're less biased. That might be just one way to circumvent the gender biasness, especially when you're raising in very difficult times like COVID.
I want to add on to this a bit more. I know this is like a very popular question. I'm loving all of these answers too. I think for me, I was seeing really early on that there was going to be this bias, and especially given the business I'm in with period care, I hear so often like, oh, this does not relate to me at all. And I'm like, that's just simply not true. But at the same time, they're there to evaluate a business. So for us, I knew I had to have my metrics down really, really well to overcome any of those biases. And I encourage all female founders, any minority founders to do that, and ensure that there are no holes there for them to pick at, when in reality they're picking at something that is their own prejudice or bias, and that will help quite a bit. At the same time, I often hear that you need to be scrappy for a very long time, and we were barely spent any money for an entire like year and a half. And so when people say we're too early, although we have plenty of revenue, plenty of customers, have been launched and live, and they realize those next steps take funding, if we can draw the map out for them in a super clear way and really emphasize that they're investing in what can be a very successful business, then they start to listen, because all they oftentimes care about are those dollar signs. So you got to explain to them in their language a little bit.
Yeah, actually, I think what Katie said is so spot on, but I, kind of inspired by Rebecca here, like what we're talking around is like a women's experience fundraising is just fundamentally different from men, because of biases, because of structural misogyny, because of a whole series of underlying reasons. And I think to Rebecca's earlier point, that what I think got us here is like the inequities around everything that is VC, and the numbers are abysmal. I mean, 2% of VC money goes to women, Black women, and the numbers just get like more and more just pathetic, quite frankly, in terms of what's allocated to women. That I think to Katie's point, like your finances have to be a place that evens it out somehow. There's a tendency, statistically speaking, for women to underinflate compared to men. And I think it really is in the model where you can like try and break away from a lot of the biases that happen in those conversations.
So just a quick follow-up question on my end, since I'm at a very early stage with my startup. In terms of looking at VCs in the future, would you recommend looking through like, oh, who's in that VC, and kind of moving forward with VCs that have more females on, visibly on the side? Would you say that this is a good approach?
I think there's a little bit of a catch-22 where like I think a lot of women in VC are tired of being pigeonholed to just the women deals. They're always being handed, especially, we happen to be 2 women founders working on a product for women. And so, all the women VCs are like, really, you're handing me this because I'm a woman? And so there's that. And then a lot of the men don't get it. I had a woman advisor I was talking to one time who said, I think they see it as a vitamin and not the painkiller that it really is. And I think that's really true. And so it's like, I guess the short answer is there's no real clear answer. You want to see investors that are investing in kind of, that you fall into their thesis well, but then there's also the, they can't necessarily invest in a competing company to what they've already invested in. So that's a little tricky. And another thing about raising for a product that's for women is I've gotten a lot of men say, oh, I can't invest in you because I'm already invested in this completely different product for women that has nothing to do with your business or business model, because they kind of lump them all together. And so, sorry, that was kind of more of a rant, but I think that it's more nuanced, and that's where, talking to people who have experience with these different investors becomes so helpful.
Yeah, thank you so much for those insights. Those are super useful. And with that, let's move to something entirely different, to accelerators. So a quick question, what's the purpose of an accelerator?
I can take this probably. I ran an accelerator as a founder. In my opinion, accelerator really works well if you're a first-time founder. You don't have a network of founders or entrepreneurs or investors to reach out to. So accelerator is generally more like a crash course in being a founder. You go with an idea, or you have a scrappy, whatever, rough idea, and you go in with that. And accelerator generally has group of people who are expert in certain areas, in business planning, or in tech, or in investments, so on and so forth. Some accelerators also invest in the startups to just give them that pre-seed equity. So most often accelerators, they are like your first step to kind of get into the world of entrepreneurship. And most likely you are, more often than not, probability is higher that you end up with an investment. So this works. I mean, it works for people who have established network, but it works better if you're being first-time founder and you need a lot of support to move further.
Mm-hmm. This explains a lot, and it also ties into the second question and the third question, which is to what extent is it actually important to become a part of an accelerator? You mentioned first-time founders. I wonder, like, if there's more to it.
It's both the ways, right? There are also people. I have not, in my experience, I haven't seen people who have been 3-4 times founder to go back to accelerator because they've exited, they have network,
Mm-hmm.
they've been there. So probably it's easier for them. But to what extent is it important to become? It is very subjective. I know of my classmates from Harvard who became part of Y Combinator. So people who came with network, people who came with tags and access to the network, they still went to the accelerator. I think it's very subjective. Most often, if you are a single founder and you don't have a co-founder, then it makes more sense to go to an accelerator, right? Because you just want a lot of mentorship support, which you will not have access to. A lot of accelerator programs also give you a free working space, access to a lot of tools that they have partnership with for free. For instance, Y Combinator gives you free access. They have partnership with Rippling, so all your payroll payment system, if you want to access it through Rippling, is free. So a lot of people do that when you're looking for tools, when you're looking for support, not just in terms of capital, but human support or just to get shared working space. So to some extent, it really, really helps. But I wouldn't call it a deal maker or a deal breaker in the success of a startup.
Mm-hmm. Yeah,
I
that's
think
good.
also from what I've observed, so some accelerators charge a fee to be part of them, and some accelerators take equity in your company. And certainly, I think the ones that charge a fee are a lot less selective because they're basically looking for companies that are willing and able to pay that. And the ones that take equity, sometimes that's okay if there's, if it's good terms, and sometimes the terms are really not very good. And so I think both, what the perception is in terms of, how prestigious it is that you got into this accelerator part of it, and how much it's worth your time, your money, or your equity is, there's a lot of variables there that really make it a pretty broad range in terms of experience.
And to add on a little bit to what Rebecca's saying, I think that's definitely spot on. And you want to enter an accelerator if you're going to do one with really straightforward goals and be really intentional about why you're entering it. A lot of times, say you are a first founder and just need to understand things like product market fit a bit better and how to launch a company. But for us, we're right now in an accelerator and we're in Mass Challenge, and a lot of the tools they have are their partners. So they have a lot of corporate sponsors, sponsorships, things like that we intentionally wanted to be a part of and enter that space for. And of course, having more startup founder friends and other companies that you can bounce ideas off of can also be incredibly important for like founder morale and your team's morale too. But definitely go in with intentional goals instead of just doing it for like the name per se.
Mm-hmm.
Yeah, I think I would add on to that. I think the whole part about reputation is also very important because a lot of times when startups say, oh, we are Y Combinator graduate or we were part of Y Combinator accelerator, there's a certain reputation to it. So investors are very interested. They assume that if you were selected in a certain very reputed accelerator, that means your idea would have certain merit. And it just adds like a qualifier. And they believe that you've had guidance from who's who of the entrepreneurship world, so you probably poised better to succeed. So some accelerator actually they do add value. If you just want to be associated with them going further, it really adds value, I feel.
Mm-hmm.
Gabby, if I could just caveat this whole thing to be, just to for the audience out there listening, like neither VC nor accelerators are the be all end all to fund your business. There are tons of different ways to do this. I would, as somebody who did go through an accelerator, one of those like branded ones, there are insane benefits to this, but I just want to remind anybody out there, the veneer that these things give aren't the only path. In fact, 99% of companies don't ever take VC money. So just for everyone out there, there's so many ways to still succeed.
That's very helpful. And also to put that in perspective, how many startups get admitted to accelerators? Because sometimes when I talk to other founders who are at an early stage, there's this general vibe that, oh, you have to be in an accelerator. Like all the successful startups have to be there. Like if you're not in an accelerator, you will not be successful. So I wonder how does it really look like in terms of how many startups actually move forward with that option?
I think it's a very subjective call. I like, Karen said, it's not an absolute, it's not binary, it's not yes or no. But of course, there are benefits, but there are also certain other ways that you can succeed. I think the most important factor to succeed as an entrepreneur, as a founder, as a startup is having a good grip and understanding on what your business model is, what the traction looks like, what your product market fit is. Capital is obviously very imperative for scaling a certain product or a certain startup. And an accelerator can help you to some extent, but largely it is a founder's own vision. So like I said, it's not really a deal maker or a deal breaker to any extent. But if you get admitted, yes, it's an easy way. Like you'll not have to work very hard to build your network from scratch. There's so much to your access. And you can just get a lot of information in a very short time from a lot of resources, which will take time to build organically. But there are no set rules really.
Mm-hmm. Yeah, that's super insightful. And there's one more question about accelerators. Yes, what are some alternatives to accelerators? Because sometimes some people put it in such a way that it seems like, oh, it's either an accelerator or nothing. So what else can be done if not an accelerator?
Examples would be, how Harvard and MIT have collaborated to have media labs, to be part of media lab or innovation lab that certain universities have. Certain government programs which are more centered around innovation, where they're giving you grants or free working space like co-working space. So there are some such small programs, but I personally do not know of anything which is a very big alternative to accelerator. It becomes easier if you're on campus in school or in college, because then which is equivalent of accelerator, because you have network, you have support, you have free co-working space without any equity or fee that you have to part ways with.
Mm-hmm.
I think there's also just the option of kind of creating a lot of what an accelerator provides a la carte, right? So in terms of the networking, there's some really great networking groups out there for founders. A couple that I really like that are focused particularly on underrepresented founders are Go Paladin and Bunch of Founders, which is a Slack group. And there's countless out there. We're part of something called a founders cohort here that I'm in Seattle. So the Washington Technology and Industry Association, WTIA, has this founders cohort, which has a selection process, and they provide you some training and some connections and discounts, and you end up in this kind of cohort model with other founders. So it has that kind of in common with an accelerator. It's there's no cost to it, and it doesn't have the same kind of steps as an accelerator, but there's just a lot of groups that kind of create that network effect. And then there's just the self-teaching. I mean, any material that gets taught to you in an accelerator is available out there to find and learn, whether it be reading books or, looking online or, talking with those other people that you meet through these different networks and stuff. So I think you can piece together a lot of it. It just takes a little bit more legwork.
Mm-hmm. That's helpful. One of my favorite books in terms of startups is The Lean Startup, which is so helpful. This book changed so much in my strategy. So moving forward, we kind of already touched upon that. So I'll just leave it to you if you'd like to add anything more to it. If not, then we can jump right into the next question. Let's move forward. Okay.
I have just a quick one, and it's that you can potentially make enough revenue that you won't ever need a form of investment or an accelerator and be really financing yourself. And it may take some time to be scrappy and doing some part-time jobs along with it or even full-time, but the option that you don't need any of these things is very much a thing. And if you can create enough buzz, then you can reinvest your revenue into marketing and so forth.
I love that.
Yeah, I just want to second what Katie was saying. You can move on, but there is anything from crowdsourcing, crowdfunding campaigns like Republic and Steam Engine and tons more, to SBA loans, women-owned business loans, and of course bootstrapping. I mean, I think the name of the game, if you're a founder, is sustainability.
Mm-hmm. So moving forward, in terms of pitching, quick question, what is it and how to do it well? We have a few questions here, so those two. What is it and how to do it well?
So I guess the pitching is sharing your business with potential investors. And so it's sharing the why, the problems you're trying to solve, and the how you're solving those problems, what the vision is. You share information about kind of your user acquisition, your competitive landscape, your team, the total addressable market, your traction to date, and the ask of what you're raising. And I think the biggest advice I would have for how to do it well, and this is something that I had always heard and I just had to prove it to myself because that is me, is seriously practice on the people you care less about first. Because I am such a go-getter and I am so like, this is what I want to do, so I'm going to go do it. So I was really excited to pitch to all the people that I was most excited about as soon as I could. And I have to tell you, my pitch has probably gotten an order of magnitude better from the first pitch to the last. And I wish I could go back in time and have the people I cared most about be the last ones I pitched to, but I got a little overeager there.
Yeah.
I love that. And I just want to add, for like how to do it well, you really want to be telling a story and you want to become a better storyteller and have people really understand like why this business needs to happen and who needs it and the impact they can make by investing in it or just being part of your journey.
And I think, and I wonder what's your take on that. I think it's super important to be able to stretch out your pitch or make it super short. So have like a 30-second version and 1 minute version, 5-minute version, and even a 15-minute version, depending on the situation. Yeah,
and a conversational version versus a kind of recited version.
Yep.
Oh yeah, that's creepy. Okay. So let's move forward. To what extent did COVID affect what to emphasize in a pitch? I think I had a pretty interesting conversation with Katie about that. So would you like to start with that question?
Yeah, this has been super interesting because being in the product space at this time is kind of odd. And we really emphasized like why people would pick us now because of COVID, and also where our customers are now and how we can adapt and evolve because we really truly understand our customers. But for us, it's okay, we can deliver your period care products to your door, so you're not running out to CVS in the middle of the pandemic where you're probably going to have to get your mask on and whatever other gear that you have on, because especially during the height, many of us were trying to avoid frequent trips to like big stores. So that was a part of it. And prior to COVID, we were working on moving to co-working spaces and selling to universities and gyms. And we quickly took a pause on that because it was kind of during the height. But then just really shifted how we tell our story and like what our value prop truly is.
Mm-hmm. All right. So, and what not to mention? Is there anything that you would definitely not mention in a pitch, especially in the wake of COVID? Everyone's thinking. We can go back.
I think I've had a few pitch conversations where I'm like, yeah, I'll tell you my projections, but I have to say this is complete bullshit. Like, we all know that. And I think probably in hindsight, like, you don't name it. We all know it, but you don't name it. It's to sound confident about it. And, you know, it's that like unspoken rule, you know?
Like, don't explain too much. And actually, let's jump into financial projections right now. We have 3 key questions here. Why do financials projections matter this much right now? I think we kind of tackled that question. It's because of the whole uncertainty. So I will jump right to the second question, which is where to learn how to do it well. Not everyone has like a finance background.
I think it's important to remember something Rebecca just said. It's kind of bullshit. And why it matters, I think, is because it's a story you're painting about the potential of your company your confidence in hitting milestones that will create inflection points that can create returns. But I think more than anything, I think you do it well by coming back to your model relatively frequently after like major stuff and reevaluating it. But it needs to be, I think, part of a larger narrative that is painted in numbers.
I've been recently working on my financial model, and I have this whole list of assumptions. It's assumptions, assumptions, and assumptions, and then assumptions are referenced in my output page. So when investors actually look through your financial projections, what are some of the red flags that they might see that might make them say, we don't want to move forward, especially at this point in time?
I've had investors. Oh, sorry. Go ahead. Please go.
Okay. I think being very overambitious in your projections is a big red flag. I think with or without COVID, a lot of entrepreneurs, they want a very beautiful Excel sheet and a very promising Excel projections to show like my business has it all, without really having substantial proof, evidence, or subject knowledge to back it. So that is a red flag. So make sure that whatever projections you're putting on your Excel, you're able to defend it, either in terms of living proof of your traction at present, or anything substantial that you're going to do, which will lead to that kind of projection. So I would say like probably running few scenarios, saying like, base case scenario and the most optimistic scenarios, kind of give those scenarios to the investors to give them an added comfort that as an entrepreneur, you know what you're doing. You have a solid strategy to deliver that. And you also optimistically cautious that if something goes wrong, what would be the worst case scenario for them?
Mm-hmm. That's very.
I was going to say the opposite end of the spectrum of red flags, which is, I think I've been a little more conservative, buffering my estimates, and I've had investors, both VCs and angels who want to be like VCs, say, I only invest in companies that I think have the potential to be unicorns, because otherwise, because that's the strategy is like you make a bunch of bets, but each one of them has to have potential to be over $1 billion valuation, which is fine. But I'm like, okay, well, I don't think we're going to have $1 billion of ARR in 5 years. Like, I don't think we are, but they want you to that's almost the impression I've gotten, is they want you to kind of come up with the math that proves that it is, or it's less interesting. And I did get, I will say in terms of the how to learn, I will put in a plug for getting great advisors, because that's been really huge for us, that we have a few advisors and each one has a really specific kind of talent that they bring to the table. And so one of my advisors has helped a lot with the financials, the business strategy, the pitch strategy. And one thing she told me is that when you talk to investors, they're already applying a buffer to anything you say. They're already discounting it by their own buffer. So if you're also applying a buffer, then that's double buffering it. And that, right? So basically don't apply your own buffer. They're already doing that for you. And I felt like that's kind of helpful advice that I will bring into my next round of raising.
Yeah, that's very helpful. So with that, let's jump into the summary before we jump into questions. And then we have 2 announcements as well. If each of you could share like a key takeaway, basically one sentence that you would like someone to take away from today's panel. We can start with Karen.
There are many ways to fund your company. And as women, I think we already have it hard, difficult as it is. And don't feel pigeonholed to follow a VC track or an accelerator track. You have to find the investors and the capital that's right for you and your business, and ultimately what will allow you to bring this vision further into the world.
Mm-hmm. Thank you. Let's go, Katie.
Yeah, I would say to ensure that you're selling yourself to your full potential and not hide any of your background and your expertise, and really emphasize it, because chances are they're not going to assume that you're an expert in XYZ. So you really need to tell them how amazing you really are.
Rebecca?
I love both of those. I would say that 2 things can be true at the same time. So your business can be going really well and you can feel happy about that, and fundraising can be kicking your ass. And both of those things can both be real experiences. And I went through a lot of cognitive dissonance of trying to reconcile, like, wait, I'm really happy because the business, wait, I'm really bummed because this investor meeting. And it's like finding space for both of those things to exist will save you a lot of the roller coaster.
Mm-hmm. And Anu?
I think being resilient and patient would be the key take away. Fundraising is a challenging, part of being a founder. With or without COVID, it always remains a very tricky part. But I think one has to be very resilient, very patient, just roll with the punches, be at it, and success is at the end of the tunnel.
Thank you. This is super useful. So quick additional resources. Rebecca wanted to share something with you, so go for it.
Oh, thank you. Well, I would love for everybody that identifies as a woman that's listening, which I imagine is a lot of the audience, to share your trails on owntrail.com. We all have a story to tell, and this is a platform to share those as a microactive mentorship. And we are doing a crowdfunding campaign right now. So if you go to owntrail.com/fund, you can see some really exclusive rewards that are tied to our future business model and some really fun stuff there. And you can follow us on all the social channels as well. Thank you.
Thank you. And then another quick announcement, Anu. I posted both of your articles here, which are wonderful.
Thank you for sharing. Anyone trying to get more understanding of VC investing or how the fundraising would look like, probably these are a few articles that can help you.
Perfect. Thank you. Okay, and right now let's jump right into questions. We still have 10 minutes. Let me see if I can access the chat. We have a bunch of questions here. Let's see. If you see questions in the chat, please let me know. I think that we have a bunch of comments here. So I'm just gonna move to the questions that our attendees submitted prior to the session. Here, if you just feel like picking any question and answering it, that would be great. We can start from the very top just to make sure that those are tackled. I think we covered some of those already.
Happy to take a crack at the second part of the first one. What is it like? What do we do to ensure that where the money went from, I guess, an investment? That's something that you want to have very clearly laid out before you go and start fundraising. What are the use of funds for? How is it going to relate to critical milestones in your business that will either unlock revenue potential or other funding rounds that you're seeking, or sustainability?
Okay, now I see the questions. I apologize, I couldn't see them before. So let's tackle the incoming questions. So we have a question, I'm just gonna read it. So, hi, I have a question about incorporating. When should a startup consider incorporating or applying for trademarks? Currently have been working with a team on an idea I pitched. We've been working together for the last 2 months, working on a proof of concept, but we never initially talked about equity. Now, the team wants to bring in additional team members. Not sure if I should start thinking about incorporating. Do you have any opinions about that in terms of incorporating and trademarks?
I think incorporating and getting trademarks are two totally separate things. Incorporating, if you're issuing equity, hiring people, making money, accepting money, any of those things, you need to be incorporated. That's my non-legal advice. But I think that it's basically, there needs to be something there's probably something that's a forcing function for you going ahead and doing that. And then trademarks are just whenever you are able to navigate that horrible system or pay a lawyer to do so.
Yeah, and I will say if you are consumer facing, and if say you're getting lots of things printed on boxes or putting a big investment towards something where you're going to have your name on it, trademarking it's a little bit more serious, and you should maybe look into that sooner. But you should also understand at really early stage, there's a pretty big chance that you will either have to change your name or you might pivot your actual business model quite a bit, so your name won't even make sense anymore. So I wouldn't get too caught up with that until you're like really launching and scaling and everything is set.
We also have a question about, can you talk about the progression to raise funds? Should someone go from friends and family to angels? Can you explain? If someone could tackle that.
Sure. Go ahead.
No, go ahead. I'll wait for you.
No, I think that funding rounds should be like sort of consistent to milestones in your company, right? So if you've got an idea that the next version 1.5 of your idea can use some family and friends round, or a couple $1,000s to get it to its next point, I think that's how you should be thinking about it. I think fundraising should always be tethered to the building of a product or the milestone of a company.
Yeah, adding on to that, I would say it is more about your capital requirements. So when you're starting off, you probably don't need somebody to write you a $5 million check. So it is okay to go to angels and friends and family and probably raise a smaller round, have a working model or have a working product so that you can then pitch it to other institutional investors because they generally go for big ticket sizes. So, especially if you're a first time founder, don't have any track record, then it makes sense to kind of raise a smaller round from friends and family, have a working product, show them traction, and then aim for a larger check from an institutional investor. But this is pretty much like what Karen said, that it has to be milestone basis, right? So first is probably just a requirement of $200,000. Another round, you need $5 million to stay afloat for two to like 3 years. So that could be like two or three angel investors. And then when you're raising a larger round, like if you want aiming for 10, 20, 30 in just one go from one investor, then it makes sense to go to institutional investors because they have deeper pockets.
Mm-hmm. Someone is also asking about whether a pitch deck is a must-have or not necessarily.
It is. I can definitely share my experience. I made that mistake. And to be very fair, in my second startup, my funding was just shelved overnight. So I had 30 days. I was very bogged down and I was like, oh, what can I do? And I was like, I was just randomly writing emails to VCs and I was like, I just need funding. I need a meeting. And everyone pretty much came back with the fact that where is your pitch deck? It is very, very required, especially because you're writing and making introduction over the email. They don't know you. There's some paragraphs are not going to be helpful. So a pitch deck, not exceeding probably 5, 7 slides or like 10 slides. Just giving a small introduction of your business is very imperative. Getting your pitch deck right is also very, very crucial. I know some investor, much later, he told me like after I sold my startup, he said, we didn't entertain you because the pitch deck was not appealing. So I think it carries more weight than we think it does.
And here's a follow-up on that question. There's a clarification that the person who asked this question wanted to know what are the must-haves in a pitch deck or don't-haves in a pitch deck.
I would restrict the length of the pitch deck. So that's first, not making it elaborative 20, 30 slide pitch deck. No, keeping it very concise. I think I'll optimize between 5 to 10 slides. What must have in those pitch decks should be some details about the founder or the founding team, a brief synopsis of what your business is doing, followed by what the current traction looks like, and then eventually having a slide in terms of your projections and ask what is the valuation, post money, pre-money valuation, how much equity you parting ways with, and what kind of fund are you raising. So just brief synopsis about that. These are, I think, must have.
And can I add a question that didn't get asked related to that? Because I think it's an interesting one that I've grappled with and still haven't totally nailed is, should you send people your pitch deck or only use it for pitching or send it after you pitched, right? Because here's the thing is that hands down investors keep asking for your pitch deck and you want to pitch to them before you actually send the whole deck is the advice out there. So there's this total push pull there. And so I've created, a 1-pager kind of executive summary thing that has the meat of it. And I'll try to get away with sending that. But some people really push for wanting to see the deck before they meet with you. And so actually, I'd be curious to hear if other people have totally figured out the rubric around that. But it's an interesting tension that exists between founders and investors.
I think in my experience, fair share of my experience of raising funds repeatedly, you are right, there's a push and pull, but I think it's easy to just send like a short synopsis of 5-page pitch deck to the investors. And then I save a lot for like our subsequent conversations when we're meeting in person or I'm doing like a full-fledged presentation. Then I probably try to make it bigger. But this is my experience. I've never wrote an email without sending a small pitch deck.
Oh, and I actually have like the best piece of advice around pitch decks that I know, and you probably all do this also, is DocSend. I'm completely obsessed with it. So docsend.com, I think. But basically you upload your deck, then you create a custom link for each person you're sending your deck to. And you can upload other materials too. That's where I have my one pager. That's where I have like a list of anecdotal feedback that I'll send some people. And then it will show you who's viewed your deck, how long they spent on each slide. So you get all this analytics on it. And when you need to make a change to your deck, you just re-upload it and all the links will go to the new version. So you can do versioning and you don't have to like resend them the new one. So it's like, I think, not very expensive at all. And they have a free trial for the first few months and it's so worth it.
Wow, this is incredibly helpful. Thank you for sharing. This sounds awesome. So with that, we're gonna start wrapping up since we're out of time. So I wanted to thank you all for sharing your knowledge and your experience with us. I've learned so much. I took some notes. You may have seen me write. So thank you so much. For all of those attending, thank you for joining us today and listening. Please visit Products by Women to hear about more events and study circles and panels and other resources, including podcasts. It's a really fantastic platform with fantastic women who are super supportive and empowering. So yeah, with that, thank you so much. And we will send you the recording after the panel. So thank you.
Thank you, Gabby.
Thank you all. This is really fun.
Good to meet you all.
Weekend.
Good night.
Good night.